Bruce Flatt, the CEO of Brookfield. He's in London. I'm at my house in New York. We're making it all work. Bruce, you and I have talked a lot about this strange world that we're living in. I'm so excited to get your perspective on where we are and where we're going when it comes to the world and the world of real estate. First of all, how are you? What's it like in London? What's it like for your employees across the world?
Good to be on, Jason. Thanks for having me. And I would just say that leave aside the health impact of everything. The only thing constant in life is change, and we've witnessed from all across the world the closing down of offices and the opening up of offices, and we're virtually opened up all of our offices globally, and we're back up at some offices 100%. In London here, we're probably 65, 70%. New York, we're 25 or 30. So the numbers have been going back up, and it's taken us 3 months. It's been stressful for a lot of people, but the bottom line, this will pass, and this is the crisis of the day. But we'll look back at it, and some small things are going to change, but a lot are going back to where they were, and we'll have another crisis in the future, I'm sure. That'll be just as bad as this one when you're in the middle of it.
So, what are those small things that have changed? Because you have a window, literally and figuratively, into how we work. We spend so much of our time at the office, we spend time shopping. You also have a window into that. What are the things that you see that will change in the short to midterm that we should be thinking about?
Yeah, so for offices, once we shut down office buildings around the world and people went home, we started thinking, this is 3 months ago, we started thinking about what is it that we need to do to get those offices back open. And that has included all of the things that you have seen if you're in an office today, or you will see when you shortly go back, which is there's more distancing. Elevators have spacing out. There's more cleaning. Our air is better than what you're breathing in your house because we are taking particles out of the air that we never took out before. So all of those things are happening in office buildings today, and they are going to be some of the safest places in the world to be in the future. In retail, there's no doubt there was this trend that was going on, and the trend was online and good retail were moving together, and retailers were using them together as one space to deliver goods to customers. And that's going to be accelerated, there's no doubt, with curbside pickup probably increasing and other things happening. The trends that were happening are going to continue to increase, some of them exponentially as we come out of this.
And it's safe to say, and I know that this is your business, but you're still long office as a way of working. You've talked several times over the past few weeks about the power of people being together and those sorts of things. I think we're seeing that manifest even in our social lives. Just help me understand that a little bit.
So here's what I would say. Our view is that office space, after talking to virtually every company that we lease space to, that they're bringing their people back. The only reason some are saying we're actually not bringing back everyone right now is they don't have enough space to be able to have social distancing while that's important to bring everyone back. So they may be bringing back 50% of the people because of that, but eventually they're going to bring them all back. And I guess the point I would make, and I think this is in our company, but it's in other companies we talk to, the office is about the social interaction of people. It creates a culture in a business. The spontaneity and the collaboration that comes from an office is incredibly important to a business. And you can't create that by video conference. You can maintain it for a while, and that's what we've all done for a little while, but you really can't do that over the longer term. So offices are going to be incredibly important, as they were before. And in fact, today, Jason, we're actually leasing greater amounts of space to people than they had before because they want to accommodate all our people and get them back quickly. And so they're increasing their footprints versus taking less.
And so, do you think the nature of cities change, Bruce? I mean, you're heavily invested in New York, London, other big cities around the world, but you also have an expansive portfolio outside of cities as well, I believe. And so, as you think about building out your portfolio, especially around the world, do we live a more, and I'm talking to you from the suburbs, so maybe this is a loaded question. Do we have a more suburban life? Do cities change in their nature a little bit?
Look, I think that I don't think that the trend that's been happening for 25 years, which is that people are moving into cities because, just like I described for office,
Hmm.
people like to interact socially with other people. We're social animals. And that's been happening for 25 years in a significant way. And the trend is that urban cities are growing and growing and growing more. And I don't think that changes at all. And yes, there will be the few people that decide I'm going to go somewhere if they have a job that will accommodate that, and that might accommodate that. That might be some, but it's going to
Right.
be in the minority. And I think the inexorable transformation of these cities and what's happened is this has made cities amazing places to live. The culture, the arts, the restaurants, the everything that's there, and because it started with young people because it was affordable and it was near the office, and it's now become older people because they choose to live there. And I don't think this
Right.
changes it at all.
Yeah, it's interesting. Even I was in New York City for the first time this week in several months, and there's a different feel, and obviously we're not as far along the way back as I think London is in many ways. But even contemplating closing down some city streets, outdoor dining, it does feel like what will change is actually the type of vibrancy maybe that we have, and certainly you've seen that. I think about Canary Wharf. I think about Brookfield Place down on the lower tip of Manhattan, where you are. I mean, you've sort of been anticipating this and seeing it. Even when I think a little bit up from Brookfield Place on the west side of New York City, uh, this sort of collision of all these things and the, as I said, the vibrancy of the city. It seems to be pretty resilient.
Look, and some of the reasons why we don't get that over excited about the situation that currently goes on is that we've lived through many of these situations before. We lived through the real estate crash of the early 90s. We lived through 87. We lived through 2008. We lived through 9/11. And specifically on 9/11, we had properties, major properties downtown. And everyone told us no one would ever come back to a building. No one would ever come back to Lower Manhattan. No one would ever go above 6 floors. And all of those things were wrong. The real point was that the small nuances, though, around the edges change some things. So there will be change, but it's nuanced change, and trends will accelerate. ESG trends will accelerate out of this, and different things like that, renewables. But I think it's around the edges, not some of these major things that are happening.
About renewables, because it feels like we started 2020, which it feels like we started 2020 about 25 years ago, but here we are. It's only June. And it was a moment, it feels like, where corporate CEOs, investors were starting to galvanize around climate and, by virtue of that, renewables. Obviously, the world, as we know, has changed a bit, but what is the state of renewable investing? Because I know it's an area you have focused on, and how does that play into the short and midterm thinking here?
So as you noted, we've been a renewables investor for 25 years. Before renewables was renewables. We have a major hydro business. We got into wind years ago. A number of years ago, we started investing into solar. And what's happened, and this is the most important point, is there are nuanced changes in things that are just on a trend. But when technology and manufacturing capacity collides and brings costs down, it can change things dramatically. And what's happened in the last 3 years is that solar in many places of the world has become the lowest cost generator of electricity. And that is a very significant point. You still can't store it, so that doesn't mean that gas plants are going away or that nuclear plants are going away, but it's going to, the solar generation for renewables is going to continue to increase. And that's really what is allowing corporations to now say, we will get on the bandwagon of having renewable power. And so I think out of this, I think more thought will be put to corporations being responsible in many different ways. And I think renewables will be one of them. And I think you will see the trend accelerate coming out of this situation. In addition to that, we need to spend money into infrastructure to get the economies moving. And this is one way you can get the economy moving in a fast and efficient manner.
All right, let's talk about infrastructure, because on the political side here in the United States, we hear a lot about it. You hear about it in Europe as well. I feel like we have heard, I mean, it's become a running joke in the United States in political circles of it's infrastructure week, as you well know. Meanwhile, the private sector, including yourself, has been especially active in this, and especially globally. A huge deal announced just in the last 24 hours, you partnering up. You and I were joking about this earlier with Global Infrastructure Partners, sort of the two big boys coming together to do the biggest deal in infrastructure so far this year. It involves Abu Dhabi. Tell us the significance of that ADNOC deal.
Look, the actual transaction was reported, so I won't specifically get into that, but I'll use it just to segue into saying that what we're doing with ADNOC as a group of investors is providing them with capital at a very low cost to be able to outsource infrastructure from their balance sheet. And it's I think, a fantastic transaction for ADNOC, for Abu Dhabi, and for us as investors. But what it also shows is that corporations and governments are going to have and will continue to outsource major amounts of infrastructure and infrastructure spend around the world. And the one point I think that's really important here is the acceleration is going to increase because corporations have more debt and governments in particular have more debt. And therefore, this is even more important to them because there's only two ways you can get revenue into either a government or a corporation: is increase sales, which may or may not be possible, or sell assets. And these are highly saleable assets that can possibly be as well run by, for governments, be as well run by private industry as they are by governments. So I think that trend will continue to accelerate.
So that accelerates in a meaningful way over the next 6 months, year, and on?
Yeah, look, I'd say it always comes in, it starts in different places, and ADNOC was very forward-looking. Many of the emerging markets have been doing it over years, partly because they didn't have the capital that the rest of us had, meaning the developed economies. But you're going to continue to see outsourcing of infrastructure for the next, look, I think it's the next 25 years. And it's starting now. That's one transaction, but it's going to increase and continue for literally the next 25 years. And you can look at the amounts of debt that are piling up in virtually every single country in the world, exacerbated by the current situation we're in. And that has to get off the balance sheet. And therefore, infrastructure, less spending because we will spend on infrastructure, on new infrastructure, or build new infrastructure for them, or outsourcing of infrastructure that they currently own is going to continue increasingly.
All right, we got a couple questions coming in from the audience, but before we get to that, I did want to ask you about your own investors. And we've talked about infrastructure, we've talked about renewables, we've talked about sort of the more classical commercial real estate. Institutional investors, they've been a big fan of private capital vehicles for the past few years. A lot of money has come from pensions sovereign wealth funds, endowments, et cetera. You know that better than I do. When they are calling you up, when you're on Zoom calls from dusk till dawn, from dawn till dusk, maybe from dusk till dawn too, you're on all the time. What are they asking for right now? What are they especially interested in that you and the team are doing in terms of new types of vehicles or areas of investment in the short term?
Look, the one thing that's I think important is that it's and this is why offices and going back to offices, it's why they're important. It's why seeing people and individuals is important. Um, uh, Relationships with clients are extremely important, especially in times like this. You can't start up new relationships by Zoom. That is virtually impossible, and therefore there's a great advantage to the investment managers that currently have large numbers of relationships. Luckily, we're one of those. We've been putting money to work slowly into the markets in all of our major strategies for our clients. We haven't sensed any pullback from that, and I think, in fact, what's really occurring out there is that the fixed income alternative that they had before, being bonds, or the fixed income investments they had before being bonds, have now gone to zero, and they have no other alternative than to allocate more of that to alternative products. So more money will go to alternative credit. More money will go to alternative private equity, real estate, infrastructure. In particular, we're seeing money flowing into core plus products because of the income that comes off of them as a fixed income supplement.
All right, so I want to turn to some audience questions because they're really good. Ferris asks, are you contemplating, buying retailers who are large tenants of your malls? Is this a plan to save retail real estate in the short term, or do you have plans to revitalize brick and mortar over the long term?
Look, our retail real estate business is twofold. We deliver spaces for retailers and they outfit their stores and they rent them from us. And secondly, we're redeveloping many of those centers into other uses where we have, because these are amazing pieces of property in the middle of cities. So it's a two-phased plan. Prior to this COVID situation, we had been buying some retailers because what we have is very deep relationships with retailers. We know the ones that are successful because we deliver goods for them. And to the extent that they need capital in this situation and that we can make investments, we think we have greater information than most people. And therefore, the investments we make, we know who to pick, and we can make them successful and make a good return off of it. So this is an investment opportunity. It's got nothing to do with our retail real estate business, because all of the retailers that are good will be recapitalized. They may get new owners, meaning debt may get converted into equity, but very few just liquidate. And the ones that do liquidate, those ones probably were going out of business anyway. This will just increase the situation, and that's actually good because it means that we'll get the lower quality retailers out of our centers. And when you have great centers, you always have a large amount of space, people to fill those centers. Incidentally, a lot of them from online presence that are opening stores, and that's this collision of retail real estate and online sales. And I think you're going to increasingly see.
It's an omni-channel world we're living in, Bruce. And presumably, I mean, you know as much or maybe even more sometimes than the retailers themselves about what performs best where. So I would imagine, not going overboard, you have a competitive advantage there in terms of picking winners and losers in retail.
Look, our whole business is about being value investors into things that we know. And by virtue of our position, we know who does well, where they're doing well, and what they do, and then we can look at their capital structures and put capital in the ones that make sense. The ancillary benefit is it may help out our retail real estate business, but the real goal is to make money for our clients on the retailers And the ones we've done so far have been very successful.
One other audience question as we start to wrap up here. Colleen asked, do you see an immediate need for innovative urban design and architecture, or do you think cities primarily either retool their current facilities or make do with what's already in place? Are we going to see sort of an architectural response maybe to especially the health crisis that we're living through right now?
Look, I think great cities transform themselves over time. It takes very long periods of time because these are not simple transactions. Usually, from start to finish in a place like London or New York or Shanghai, it takes 6-8 years to build an office building. By the time you think about when you're going to do it and empty out the tenants, tear it down, and build a new one. But what is important is these cities need new space, and I think you're going to see an acceleration that people will want to be in high quality spaces which provide best in class of everything, and that can be done in new operations, not necessarily in old. And so increasingly, I think you're going to see people there's going to be the good and the bad separate even more after this crisis in all types of real estate.
Last audience question. Going forward in the energy space, will you continue to build nuclear plants with your Westinghouse unit? Do you see value in new builds as something that you want to deliver clients?
So when we bought Westinghouse out of bankruptcy, it had two businesses, a construction business that got itself in trouble, unfortunately, and a servicing business. We did not buy the construction business out of bankruptcy. We own a servicing business, and we service a large portion of the fleet in the world. And this is an amazing business that has very high sustainability of cash flow because you don't turn nuclear plants off. In fact, they're an essential service, and they ran throughout this whole pandemic, and cash flows were more or less what we thought they would be through the situation. And there's not many businesses that can say that as an essential service. The difficulty with nuclear is construction of new facilities. Westinghouse participating in some in the Middle East and in Asia, but it's difficult elsewhere. And I think with solar capacity coming in, that will that changes the situation in some markets. But it's possible that new nuclear plants do get built in the future, but it just takes time for people to get there.
Well, before I let you get on with your afternoon, I have to ask you, Bruce, because you've been doing this for a while. You mentioned at the top of the conversation, you have seen a number of crises. You have managed through this and are continuing to manage to do that. As a leader, as a manager, what's the biggest lesson for you?
Look, I think this crisis, the difference in it was that everybody in the world got affected. Normally, when there's a financial crisis, it's a bunch of financial people or the senior bankers or people that work at banks that get affected. Or real estate, it was a real estate crisis. Or oil and gas, it was an oil and gas crisis. This one affected everyone. And not only did it affect everyone in your company, it affected all their families.
Yeah.
And the most significant thing here was and is that we need to make sure that people and all their families and all of our employees and their hundreds of thousands that we have are comfortable and are getting back to work, and we can help them. And that's been different this time than in any other situation, because this was very broad-based. Every business, every company, every employee in some way was affected, and that normally doesn't happen in a financial or economic crisis.
Well, it's great to see you, even with all these miles between us. Hope to do it again in person before too long. Bruce Flatt, CEO of Brookfield, joining me from London.